Just a quick shout out, I guess. We will soon be releasing our views of the tax impact of the manifesto pledges, contract pledges, as Nigel Farage would like us to say, that have been made. So please look out for that. This is not a political statement at all. It's simply looking at how those taxation issues and how they will play out for our clients. Should those pledges come into force. But today, Tim is here to talk to us about company tax computations and the tax issues. Tax and companies it used to be a fairly straightforward matter, but over the last 10, 15 years has become extraordinarily complicated. And so I'm delighted that Tim is going to spend some time today talking to you all about how those work. Quick little bit about it's Gravita, not Gravita. Although I'm not sure which one's better, but it's Gravita. We're a top 30 firm and growing all the time. Got 400 or so people who work here, about 40 of which of us are partners with full service. So we do everything, all the stuff down the right-hand side and many other things. But both Tim and I, of course, are tax consultants at heart. So we try and help our clients from wherever they are in the world, whatever they are, people or businesses, navigate the UK tax system as best we can. So if you have any tax issues, either from a corporate computational perspective or anything else, then please reach out. We'd be delighted to help. So with that said, Tim, over to you.
Thank you very much, Tom. Great to see you again today. Don't put me off in future and before I start my webinars. No, I'm only joking. No,
Utterly my fault, Tim.
Only joke. Right, away you go. Right, okay. Good morning, everyone. Welcome to this Gravita webinar on company tax computations. I'm delighted so many people have tuned in this morning. You need to set the notes, right? I'm really going to focus now on company tax computations. You need to set the notes in front of you and you want to mark up the notes. Now, Hillary is brilliant. I really am very happy every time Hillary is in charge of my Zoom webinars. And if you haven't got a set of the notes, she will sort you out with them, but you should have them because we did remind you about needing the notes, and you want to mark up the notes with my extra comments the whole way through this morning. Okay. But can I just say that, you know, I'm going to try and cover an awful lot in the 1 hour that I've got today. Normally this is 3 hours, but I'm going to try and condense it all into 1 hour. And if you've got any consultancy needs, as Tom said, tax consultancy needs, reach out to us. We've got an incredible tax team. The more I'm involved with Gravita, the more I really appreciate how good the guys in our team are. You know, I throw a lot at them. You know, I lecture around the UK. We get, following my lectures, everybody knows I'm part of Gravita now. And we get a lot of different work, different consultancy. And I can honestly say that everything I've thrown at them over the last period, they've dealt with. And if there's things we can't do, we have, you know, extreme things. We have contacts where we can get the job done. So if you've got, as Tom said, if you've got any tax consultancy needs arising from today or in any other area or an audit as well, reach out to us. Tom's email address is on the screen. I think he's the focal point, really, as he normally is. He's excellent at that. And reach out to us if you've got any tax consultancy needs in the future. Right, my background is corporation tax. I must admit, in the 1980s, I worked in the in-house tax department of P&O, the shipping group. I'll give you very briefly the story behind that. My dad knew Sir Geoffrey Sterling, who was the chairman of P&O in the 1980s. And he arranged an interview with me at P&O, the shipping group, to work in their in-house tax department. I started at tax when I was 18 and after my A-levels. And Dad said to me, he died shortly after that, he died when I was very young, but he said, you need to spell in industry to see how industry works in an in-house corporation tax department. So I went to work for P&O, and I didn't, when I joined, I didn't know that they owned Bovis, the house construction, the construction company, civil engineering, everything. And it was an incredible group. At that time, it also had a bank in it. It was just amazing. So the experience I got, you either sink or swim. And I think the best thing that I enjoyed about working for P&O was there was no timesheets. I've been used to the timesheets, throughout my career to that point, and suddenly working in tax, there was no timesheets, but there was so many other things that made up for it, such as the horrible year end, sorting the deferred tax out, which at one point I was in charge of, allocating the group relief, warranties and indemnities when we sold companies, but it was an incredible time. So I've always had corporation tax. It's always been my thing. And I learned at a very early stage, dealing with multi-million pound figures, that if you've got a tax dispute with HMRC, maybe on some of the things that we're going to talk about now, the key to it is how you present your case, how you argue. If you have to go to a meeting, you've got to plan that meeting out. And sometimes you've got to think, right, where are the big things where I'm going to win with this? And you've got to plan. That's what I've always done, and that's what I think Gravita do. And, if you have tax disputes with HMRC, Dion could help you. We would love to help you in this area. But the key thing to all of it is how you present your case, how you argue and present your side of things. For example, landscaping. This was a big victory that I had for a client a few years ago now, and I'll give you the background to this. You will need the notes in front of you, as I've said, and this is on page 2. But quite a few years ago now, the company, an accountant approached us, and he had a client that was a big hotel, part of a hotel group. You could note any of this down. It's on page 2, but landscaping. And he said, we just got a wedding license and we can have weddings in the gardens. And I said, well, I know your hotel. If you have weddings in those gardens, you won't attract anyone. And he said, yeah, we need to landscape the gardens. And he said, do we get tax relief? And I looked at the revenues manuals and I really researched it. And HMRC feel that landscaping is capital expenditure that doesn't attract capital allowances. And so I thought to myself, yeah, but I don't think that's right. That's their interpretation. And I'm thinking this hotel is going to spend thousands and thousands landscaping their gardens. And this is a huge expense, to earn profits, to put them into a position to have the weddings at the hotel. And I came up in a meeting with, many years ago with this term themed landscaping. And we argued it. We actually had to go to a meeting with HMRC, and we said this landscaping is the key to the weddings at the hotel. It's theme landscaping. It's functional, playing a major role in the trade. And to cut a long story short, we won and we got it. And we've helped another firm of accountants get landscaping allowed for an Oriental restaurant where they landscaped, had Oriental gardens. So it's something that we've been quite involved with, but I can't guarantee it. It's, as I said at the start, it's all about how you pitch your case, how you explain, how you, what line you go down, how you argue. But we won with the landscaping. And really this is a bit like a history of some of the things we've done in the tax computations. But the next one, I was staying at the Europa Hotel in Northern Ireland in Belfast, right? And I actually met a director of a company who was having a big function. They'd hired the ballroom at the Europa Hotel in Belfast. And we got chatting at the bar, beautiful bar there. It's an incredible hotel. Every time I went there, this was nothing to do with tax, but I seemed to bump into Barry McGuigan, the boxer, and the boxer promoter, and I got to know him quite well. But the company that was having the function at the Europa Hotel in Belfast, they put on this big event, hundreds of people. It's a massive ballroom. We got chatting, the company who ran it, the director, and he said, do I get tax relief for this function? And I said to him, you want to get an itemized bill from the Europa Hotel, splitting the bill between the hire of the ballroom, allowable, and the food and drink, not allowable, that's entertaining. And we helped these people, and they got it. They won. They got the tax relief in the computation for the hire of the ball, which was quite expensive, but they disallowed the food and wine for entertaining. And the hotel split the bill. And I said to them, I think the reason you're going to win is it's a business promotional event. It's so obvious it is. You've made presentations. You've actually videoed the presentation, and you can show that video to HMRC, which they did. And they won, and they got the hire of the room allowed, but not the food and wine. And what they did, they used a tax case. And if you turn over to page 3 of your notes, the tax case was NetLogic Consulting. All right. And that tax case is it's the tax case on business promotional expenditure. You know, I know there's going to be different people watching today, different levels and everything. But if you've not used that case or had a look at it, you want to research that case. NetLogic Consulting, the details of it are on page 3. And the judge said, if you put on a big function, you hire a room at a hotel, you're going to get the room hire allowed. But the judge more or less said, to get the room hire allowed, there must be a presentation by senior management promoting the company. I've always took that on board. I mean, that case is getting older now, but I've always took that on board every time we do it. And one of the things we did a few years ago now was the firm that I was working for then, they hired a box at a race course, and it was a vending machine company, and the company, they hired the box, they put vending machines into the box, and they made demonstrations on how the vending machine would work. There was new vending machines, and what they did, they actually invited that day at the races into their box. They only invited potential customers. They used their salesman. It was a business pitch. And the revenue queried, because, you know, at a box at a race course, the revenue always going to think, is this entertaining? The vending machine company won. It was allowed. And if you look at page 4, I've given you 10 paragraphs, if you like, on how the vending machine company won, what they did. You want to read that. And I think that opens the door, if you argue along those lines, for various things, maybe boxes of football, things like that. So you want to have a look at that, page 4, read that case, because it was a big victory for us. And we got the cost of the box allowed, but obviously not the food and wine. We disallowed it. We were clever. What we did that day, we said to everyone who came, if you order vending machines today, in your pack that we've given you, there's a discount voucher only for people who attended today. You know, really emphasizing it was a business promotional event. And we won. And if you read that page on page 4, it shows you how we did it. And since then, I've expanded that to boxes of football, cricket. I always remember I had a day where a company launched a new car, and they hired a stately home to do it. There was a lot of expenditure. We got all of that allowed, but not the food and the wine. So it all comes down to how you present your case and how you argue. I think that's really, really important. Right, go on to page 5. Oh, by the way, before I finish the idea of business promotional expenditure, a firm of accountants, this is not in the notes, but I'm going to mention it because it illustrates the sort of sides to this. A firm of accountants told me that their client hired the Law Society rooms in Chancery Lane in London. And it was a big event, and they invited hundreds of people, clients, and they just hired the rooms, but there was no speeches. And everybody arrived and they mingled. I mean, if you've been to the Law Society rooms at Chancery Lane, they're massive. I have. And but there was no speeches, and I don't know how HMRC picked this up, but they did. And they said, no, we're not going to allow this because you've hired these rooms at the Law Society to entertain your clients, and we can't really see that it was been a business promotional event, and it was disallowed. So all these things you have to really plan very, very carefully. and argue carefully as well. I think you've got to plan before the event, and you've got to argue carefully as well. Right, go to page 5. The next area, sponsorship. Right, I'm going to have to speed up to get through everything this morning. Sponsorship. This is a big area. And a lot of people, year in, year out, come to me. I've had that earlier this year when I was lecturing in Holborn. A man comes up to me and he said, one of our clients is going to sponsor their daughter who's a promising tennis player. Can we get the sponsorship allowed? And I said to him, if you plan it properly and do it properly and you take advice and take tax advice, you will. But it's not easy. There's a case that the leading case on sponsorship is Crown and Cushion Hotel versus HMRC. Have a look at your notes. You want to star that on page 5. I'm giving you some summer reading. When you go away on your holidays and you're lying on the beach, I do. I take a load of tax stuff, but then my wife is used to this. But I do. I really take all my tax reading because I find it nice to relax on the beach and think, should they win? Do they? All the rest of it. But Crown and Cushion Hotel was an incredible case that I've used in meetings with HMRC and won with. And very briefly, I've actually lectured at one of the hotels. It was a group, and there was loads of hotels all near Silverstone Racetrack. But this group, the Crown and Cushion Hotel group, the owner had a granddaughter, Alice Powell, and she was Europe's top female, very young racing driver, very brave lady. I actually saw her race. I'm not into that, but I saw her race, and I'm thinking she is gutsy and brave. And so the hotel, all around Silverstone Racetrack, this is just, you can't believe all this, but it's true. It all happened. It's all in the case. And they decided to sponsor Alice Powell, the granddaughter, who had started to win huge races, motor racing. And they drew a contract up and they said, we're going to pay you £160,000 a year for 4 years. But they said, you've got to earn the right to have the sponsorship. We were giving you 160,000 for each of the 4 years. And it was all drawn up as a formal agreement. And the owner of the hotel group, I think it was Jim Fraser. I think from memory, that was his name. He said to his granddaughter, right, you've got to earn this. And she did. She made presentations. The group's logo was on her racing car, the website details. It was on her overalls. She made speeches. She turned up. All these motor racing enthusiasts turned up at the hotels. There was a cardboard cutout of her at the hotel, commercial contract. They'd sponsored racing drivers before, which was a big thing. She made personal appearances and they won. And if you read the case, they won quite convincingly at the end. So if you are sponsoring, you have got clients who sponsor their children who do sporting events, the next Ama Raducanu, whatever. I think if you plan it properly and the parents have got a business and they want to sponsor their children and it's commercial contract and it's justified, and you would be paying that to somebody who wasn't your child. If you can demonstrate that, I think you win. I've had success, for example, with a local restaurant who sponsored the local rugby club, and they proved that it was a commercial sponsorship. In the contract, they had to have the AGM at their restaurant and things like that. The dad had a restaurant and he was sponsoring the rugby club, and it was commercial, and they got a return out of it, and we got that allowed as well. So you can have a look at the Crown and Cushion case. It's on the next few pages, page 6 and page 7. And, as I keep on saying, it's how you argue all these things in the computation that will lead to your success, hopefully. Can I just say one more thing? So we're on page 7 of the notes. Can I just say one more thing before we move on? Not in the notes today. I regularly get queries when I present corporation tax refresher lectures, things like that, on one particular subject, time and time again. It's not in the notes today because I actually thought it was probably too big a topic to cover today. But the query that we regularly get is on associated companies for corporation tax. And so if you have any tax consultancy needs on associated companies, because a lot of it is unique, individual cases, are they associated or not? You could engage us to help you with this battle, if you like, on whether companies are associated or not. It can be very complex. It is a complex issue. And perhaps it's beyond the scope of this brief 1 hour webinar today. But remember, reach out to us. And if you've got any queries on or tax consultancy needs on associated companies, our team could definitely help you. Right, we're on page 7, the next area, fee protection insurance. Now, I know that some people are not big fans of fee protection, but I've got to be honest, I am. Why? Because I think fee protection insurance is very cheap. I think the premium is a very cheap premium for what you get. And then the company, if they do have an investigation or queries from HMRC, the accountant's time can be paid by the fee protection insurance. I was made aware of a case very early this year where a company had paid a relatively small premium, and their corporation tax computation was queried by HMRC. And the accountant's time was covered by the fee protection insurance, but it was a lot of time on it. And they came to one very big issue, and HMRC, wrongly, in my opinion, didn't agree. And the company said, no, this is allowable. It's got to be allowable. It is allowable. But HMRC wouldn't budge. And I think unfairly, and they refused to have alternative dispute resolution. And so the company was left with a decision: do we go to the tribunal or not? And I think they are going to go to the tribunal, and they've spoken to their fee protection company, and the fee protection company's had a look at it, and they've said, we will cover the barrister's fees and the accountancy fees for going to the tribunal, and that's going to be approximately £100,000. So, you know, from a very small little premium. So fee protection insurance for the right people in the right circumstances. I personally, having been involved with fee protection for 25 years, I think it's a good thing, but you can't claim it. If you look on page 7 of the notes, this is my opinion, it's not allowable. Either for an individual, a partnership, or a company, you have to disallow it. It's not an allowable trading deduction, the fee protection premium. And I put in the notes on page 7 why the reason why I think it's not allowable, and HMRC don't allow it, and I think HMRC are correct. So I'll leave you to have a look at that. If you've got any queries, you could contact our team. I'll put the email address up again before I finish today. But fee protection insurance for me is not allowable. Absolutely not allowable. Not allowable trading deduction. Right. Go over to page 8 of your notes. Go over to page 8. Transfer pricing. Now, I worked in industry for a huge group. Transfer pricing is something that in my career, I've had a lot of exposure to at various different companies. It's complex, but it's very, very important. And it's a critical aspect of international business. I'm not going to cover it this morning because we actually have a webinar on it very shortly. And you want to start page 8. And I strongly recommend that, you know, if you've got any clients, if you're a company, if you're an accountant watching this webinar, for example, and you've got clients that could be exposed to transfer pricing or could have transfer pricing issues, you need to attend this webinar. And this webinar is on the 30th of July, probably just before you go on holiday. If you're on holiday, you should get this on your phone or whatever, and you should make a note, even if you're on the beach, to watch this, because it will be really, really good. And I think it's complimentary, and it's something that should be watched. And it will raise a few worries for you, but worries that hopefully Gravita can sort out. So this webinar is going to be presented by Tom and the Gravita Tax partner who introduced me today. and Ben Miller, who's a partner at Bennett Thrasher, and he's the leader of their transfer pricing practice. You want to put that date in your diary, register with Gravita for that, and go onto our website and have a look at that. If you've got any clients that could be affected by transfer pricing issues. Okay, so that's on page 8 of the notes. Right, okay, go to Gravita's website. You want to sign up for that, the transfer pricing webinar. Right, I'm going to mention something that, thanks to Tom, actually, that I got involved with at the start of the year and have been very involved with ever since. Family investment companies. That's not in the notes today. Will you allow me a few minutes just to briefly talk about this? Because I think it's very important. We went to a meeting recently where a client said, I'm worried about succession. And immediately I thought about the TV series that my wife absolutely loved. And he said, you know, very, very wealthy client, worth millions and millions. And he wanted to give them millions to his children, but he was a bit worried about his children's choice of spouses, boyfriends, girlfriends. And he said, I really want to do some planning where I can give the money away, but at my choice, my timing, and how I do it. I've got various assets that I would like to transfer to them, but I want to be in charge of things. And we said, well, the best thing you can do is to set up and form a family investment company to do that. So for a high net worth individual, this is just a little extra for 2 minutes, then we'll get back to the notes. But for a high net worth individual, setting up a family investment company is a very effective tax planning vehicle, which you use for succession planning. So what I'm going to say to you is that I produced a report on family investment companies. And we did it for a client, and it proved very popular. And, you know, I'm really trying to help you guys today. I appreciate you coming out and watching and tuning in this morning. So if you contact my Gravita colleague, Mirella Marino, and there's her email address on the screen there, she's got that report, and she can email it to you after this webinar. So if you want a copy, if you haven't got a copy, I know some of you already have, but if you haven't got a copy yet, email Mirella at the email address on the screen, and she'll send you a copy of my family investment company report. And then if you want advice after that, we at Gravita would be delighted to help you. So many people are using family investment companies now as a succession planning tool, and I think it's really important, and we can help you in that area. Right, if we go back to the notes now, please. Go to page 9 and capital allowances. Now, can I give my views? Capital allowances at the moment, if anything, are too generous. They really are too generous. And the Conservative government set up company expensing, where you now get 100% capital allowances. The strange thing is they're uncapped. You know, there's no cap on them, providing you spend money, a company spends money on qualifying brand new 100% capital out, plant and machinery. So this is, if anything, too generous. So since the 1st of April 2023, companies are now entitled to claim 100% capital allowances on plant and machinery with no upper limit, no capital, but it's got to be brand new plant and machinery, unused assets. But remember that the company, if they buy second-hand assets, again, you've got to mark up the notes for my extra comments this morning. If you buy second-hand assets, you can still get 100% annual investment allowance on the first million, and that'll do a lot of clients anyway. So this capital allowances regime, in the whole of my career, at this moment in time now, it's the most generous I've ever seen it. And can I say straight away, I did a lecture to big companies in industry, 3 weeks ago? And they all said to me that because they get 100% capital allowances now, uncapped, for practically all of them, it was creating a tax adjusted corporation tax trading loss, which we'll come on to in a minute. And they have got tax adjusted losses now, which they're group relieving, surrendering around the group. So this is, if anything, it's too generous. I mean, 100% uncapped capital allowances on plant and machinery for companies. If you buy brand new, if you buy secondhand, you can get the annual investment allowance. So this is really definitely creating huge tax adjusted trading losses. And we'll come on to those in a moment, the incredible relief that you get for a trading loss for a company as well. Come on to that in a minute. There is one downside. Turn over to page 10. The downside is that you've got to be a bit careful with the balancing charges, because if you expense and you claim 100% company expensing on the plant and machinery, when you come to sell it, you're going to get an immediate balancing charge, and the proceeds cannot be put in the general plant pool. So let's have a look at the Harris example. Are you there with it on page 10? Harris spends $1 million. They've already spent the $1 million on, used up the annual investment allowance. So they spend $1 million on brand new plant, and they claim the company expensing in the year to March 2024. They're happy. They get the $1 million. They've already spent the $1 million on their second-hand assets. They've already claimed the annual investment allowance, but they get $1 million on the company expensing. And then in 2026, they sell that plant for $600,000. You will get an immediate balancing charge, $600,000 at 25%. The proceeds will not be allowed to go in the general plant pool. So that's the downside. So you really need to appreciate that if you claim the annual investment allowance on the $1 million at 100%, you are allowed to put the proceeds in the general plant pool if it was the annual investment allowance items, and that can be sheltered by the tax written down value brought forward. So you might just want to jot that down. We are saying to all our company clients at the moment, claim the annual investment allowance first, so that those items, when you then sell them, they can go in the general plant pool and you can shelter the balancing charge. And second, you claim the company expensing. I hope your software will do that automatically. I doubt it. You might have to override the software to do that planning, but it's definitely worth doing. Right, now, I do updates. My life is tax, Tottenham and my family, but not necessarily in that order. Notice I didn't say the England football team amongst that list. Yeah, but, you know, every week, I have to set quite a bit of time aside to see the latest tax news, but I try and do it every day by looking at a couple of websites that always tell me the tax things that are going on. And couple of months ago now, I saw this case, and it's not in the notes, but you might want to jot it down, Acorn Venture Limited. And I read this case and I thought, this is a very good case that explains, as we stand now, what is plant and machinery for capital allowances. So you really want to make a note what I'm just telling you. Acorn Venture Limited. You know, there's certain things you need to go away and do after this webinar. And I would recommend that you have a look at this case, Acorn Venture Limited. And this case tells you, it's the most modern equivalent I've seen, what's plant and machinery, what's not. What was the case about? Well, this company bought 20 basic camping pods, and they made them available to school children. And this was like an adventure holiday thing. And the company claimed the annual investment allowance on the 20 camping pods and claimed them as plant and machinery, these camping pods. Acorn Venture Limited was a tour operator that provided holidays, adventure holidays for young kids. And they acquired these 20 basic camping pods and they put them in Wales. The revenue didn't accept the capital allowances claim, and they reduced the claim. They said, no, they're not plant. And they reduced the claim by 286,000 for capital allowances, which for them, you know, for Acorn, which it was a big amount. And the revenue wouldn't play ball. They wouldn't have a review. They wouldn't have alternative dispute resolution. So the company went to the tribunal. I only hope that they had fee protection insurance taking them there. So they go to the tribunal. I thought their barrister was the people who represented them were very, very good. The camping pods had windows, they had doors that could be locked, they had walls, but they weren't a building. And the pods were anchored to prevent movement, but they weren't fixed. And I looked at them and I was reading that case and I thought, yeah, they're plant machinery. Since my days in industry, this is an area I specialize in. Is it plant? Is it not? And I thought, yeah, they're going to qualify. And the judge reviewed the position. He said the basic pods were not buildings. They were non-permanent accommodation where the children slept, giving them the outdoor experience. They were not fixed to the ground. And the judge ruled for capital allowances purposes, they were plant. I'm going to put the name up of that case again. You want to make a note of it. And that's the best case I've seen in recent years. What is plant and machinery? Have a look at that after the webinar. Right, moving on. This is disappointing, page 11. Now, in my tax career, I grew up with industrial buildings allowances where you used to get 75% initial allowance, 4% straight line. So when you constructed an industrial building, you know, used to get in the first year 79% cap allowances, and I thought that was right. It was a big outlay, the major outlay by a company financially, and I thought in those days that was the correct allowance to have. They then, I don't know why, but ages ago they scrapped industrial buildings allowances, and I started saying in my lectures we need them, and then I got an email saying that they were going to be brought back, but they weren't. They haven't been. They've been partially brought back, but not really very well. The structures and buildings allowance, and it's only 3% straight line. So if a company constructs a commercial building, any commercial building, such as a pub, a restaurant, a hotel, a betting shop, an office, when you construct a commercial building and you've finished it and it's constructed, you get 3% straight line for the next few years on your cost of construction. But remember, it's a building and a structure. More on that in a moment. So something like a concrete car park, you could get the SBAs on a concrete car park. People, do you know, you might want to note something. I see a lot of people that never claim the SBAs on structures. They're all into it on buildings, but you've got to think about structures as well. Right, okay, but this 3% is disappointing. I do know that the Conservative government were reviewing the structures and buildings allowance percentage, and I heard that it might go up, but with the election, with all sorts of things going on, we'll have to wait and see. Hopefully it will, because there are representations that it should go up. But at the moment, you get 3% straight line, and it takes you forever to get the cap allowances, it's too low. But remember, you do get them on buildings and structures. And as I said, you can get them if you, for example, were to construct a concrete car park. If you go on the internet and do a search, structures for the structures and buildings allowance, they give you some examples. That's something you should do and don't miss out on. Right, but remember, if you sell that hotel or office that you have built, there's no clawback for you in your trading corporation tax computation. There's no clawback of the SBAs you had, and the unclaimed SBAs, structures and buildings allowances, pass to the purchaser. Now, I've always thought this is very unfair, because you probably only claim 3 or 4 years, and then you've got all your cap allowances. You constructed the building, all the cap allowances then passed to the purchaser. So if you look on the bottom of page 11 of your notes, what we've done, and we've been doing this for the last couple of years now, every time one of our clients sells a commercial building on which they claimed the SBA, when we do the sale agreement, we liaise with the solicitor and we put a clause in sale agreement saying that the purchaser has to pay for the deferred taxed asset for the capital ounces tax written down value that they're inheriting when they buy this building. Now, the first time we did it a few years ago, the solicitors for the other side, they went mad and they said, you can't do this, it's automatic. I said, we can do it, we are doing it. And if you want this building and you want the massive tax allowances that, you know, we've only claimed 3 years, you're going to get, you know, a huge amount. Why should you just get this? We constructed the building. You're inheriting a deferred taxed asset. We think that we should charge you for it. And that's what we're doing. And if you don't pay, you don't get the building. I started this by my days in industry because I was so used to warranties and indemnities and charging for deferred taxed assets. And we put it in. There was a lot of haggling, but we got it. And thanks to us, the client was absolutely delighted because he got a lot more for that building. So you want to start this. It's on page 11, and we could help you with this if you've got any queries subsequent to this webinar. But, you know, when any one of our company clients sells a commercial building, for example, that they constructed, why allow the allowances simply just to pass to the purchaser? You've got to charge them for it. Right, all of that's in the notes, but you could contact us at Gravita and we could help you in that area. Right, moving on to page 12. The one other thing that a lot of accountants miss out on as well, you get the SBAs, and remember, this is quite valuable and it could go up, and obviously you've got a deferred taxed asset in your hands that you can charge the purchaser for. But the one thing you also want to remember is that if you renovate an older building, you get the SBAs on your renovations, or hopefully you will. Now, we've done this 3 times. We won 2, lost 1. The first one we did, there was a jeweler's in London, and he had a window that hadn't been changed since England won the World Cup in 1966. I could still name you that team: Banks, Cohen, Wilson, back for Charlton, Moore. I won't go on. But those were the days when we had a decent football team that were attacking. Jeff Hurst scoring the 3 goals in the World Cup final. But anyway, so this jeweler's got a very old-fashioned window, and I said to him, you want to change your window? You haven't been changed for years. We'd recently taken over the client. And he says to me, I don't get any tax relief when I put in a new window. Window is part of the premises. It's not plant and machinery. And I said, I know, but if you put in a new window, it would really attract passing trade, and you would hopefully get the structures and buildings allowance because you renovated your building. Now, this is another area that a lot of accountants just never claim. If you do the right expenditure and you renovate your building, you can claim the structures and buildings allowance. And we got that. The revenue queried it. We won it for him. We got it. And the second one we did, a restaurant put in a huge spiral staircase, massive. And we argued that it was renovating their building. We got the SBAs on that. The one we lost out on was when a client, and perhaps this was a bit dubious from the start, they put in a false ceiling and the revenue rejected that. And they said that you haven't renovated the building as a whole. But I'm trying to really help you here. And when you do the computations and you sit down, you think, right, I've got this expenditure. Don't miss out. If you're renovating an older building, there may be the potential to get the SBAs. Right, the next area, capital allowances for cars. This is another area where accountants claim the wrong capital allowances. You need to be very careful when you claim capital allowances for cars. You need to be extremely careful in this area. If you are buying a brand new, fully electric car, buy the Porsche Taycan, right? Porsche Taycan, what a car. I know a company that bought it, it cost them 120,000, but they got 100% capital allowances, and their director drives it around, and he's only taxed on 2% of the list price. And the company pays for all his private insurance, the repairs, the servicing, the valeting. They charge it up at work. He charges it up at home. So 100% capital allowances on a fully electric car. If you buy a second-hand car 18% goes in the main plant pool. And if you buy a second-hand hybrid, a low emissions hybrid, 18, but if the emissions are more than 50 grams per kilo, 6. So you might want to start that and go away and quietly after the webinar, have a look at that, because the revenue really, the government has really reduced the capital allowances on cars in recent years. While I'm on the subject of cars, I'm finding that a lot of clients now do salary sacrifice. Okay, and they say to their employees, right, you've done really well for us. Would you like to reduce your salary and have an electric company car or a very low emissions hybrid car? Or the one they do quite a lot, nothing to do with today, but I'll mention it. They say to the employees, would you like to reduce your salary sacrifice, and have the difference, the reduction, paid into an approved pension scheme on your behalf? That is so popular. So maybe Gravita should do another webinar sometime on salary sacrifice, because it's so tax efficient. But there's only 6 things you can do. The other popular thing is doing the cycle to work scheme, but that's another story for another time. But yeah, on company cars, very, very important. Right, now, R&D. We have a lady at our Gravita team, Kate Greenhow, who can help you with R&D. Contact details are in the notes on page 12, and I don't propose to cover R&D today, but I'm going to say one thing on R&D in a minute that I think is quite important. But if you've got any queries on R&D, Kate's the person to go to. I do find that some companies in their corporate tax computations put incorrect, when we check another accountant's computations, we're sometimes not happy with the R&D claims. You need the help of an expert, and we can help you in that area. But one thing I would say that a lot of accountants are not aware about is that there is a new R&D claim notification form. If you go to page 13 of your notes, there is a new notification form. The R&D landscape, so go to page 13, you want to start that and read this and have a look at this and notice this after the webinar. This new R&D notification form is being missed by accountants in the profession. And if a company is claiming R&D now relief, research and development relief, for the very first time, or they've not claimed it in the last 3 years, you've got to fill this form in. If you don't fill the form in, you don't get your R&D relief. This is so important. There's been articles on this in the leading tax magazines over the last few weeks. So important, because they're finding that a lot of accountants are missing doing the R&D claim, and the revenue are rejecting the R&D relief. And also, you've got to file this new claim form within 6 months of the end of the appropriate accounting period. As I say, if you've got any queries on this, speak to Kate, email Kate. Her contact details are in the notes, and we can help you in this area. If you don't submit the claim form on time, you don't get the R&D relief. And I'll tell you one thing, so it's no longer possible just to wait until the accounts are finalized. You've got to make the claim within 6 months of the end of the accounting period. This is really, really important. Okay. You've got to agree, if you've got an R&D specialist involved, who's responsible for submitting that form. Speak to Kate and have a look at my notes. Right, the next area, company trading losses now are absolutely fantastic. When I started my career off just after the war, wasn't quite just after the war, following England's performance last night, I'm a bit tired, slightly down with the football, not down with life. But in my day, years and years ago, when I started off, you could only carry forward a trading loss against trading profits of exactly the same trade. Totally different now. Companies now have trading losses thanks to their capital allowances. 100% company expensing uncapped. This is a more important subject than ever before. And if you go to page 14, there's so much you can do with a trading loss. You can wipe out everything in the same year. You can carry it back 12 months against anything at all. capital gains, investment income. But the big change that was made in 2017 is that a company now can carry forward trading losses against anything at all, i.e. capital gains, investment income, rent. You can wipe out the first 5 million in the next accounting period when you carry the trading loss forward, and 50% of the gains and profits investment income above 5 million. All right, so that's what you can do. If you turn over to page 15, you've got all the details there. Can we do a very quick example? Right, well, a very quick example. This company is carrying forward a 10 million loss, and they got 11 million total profits, investment income, capital gains in the next year. This is on page 15. How much of the 10 can they set against the 11? All right, I'll do it for you. You can wipe out the first 5 of the 11, and 50% of the excess above 5 million. 11 minus 5 is 6. 50% of 6 is 3. So the excess you can relieve is 3. 5 and 3 is 8. So of that 10 million carry forward, you can wipe out 8 million of the profit, investment income, and capital gains. Trading losses now are incredible. My only worry is that will a change of government do two things? Will they reduce the capital allowances company expensing, which if anything's too generous, and will they restrict the carry forward of trading losses? If you push me, I think a new government would restrict and will restrict capital allowances and trading losses. So maybe the time is now to claim them before restrictions come in. We are getting a lot of meetings with clients and they're saying, what should we do now? You know, nothing to do with today, but a lot of people are very worried that capital gains tax will go up after the election. A lot of people are doing their pre-election tax planning now, but again, that's for another subject, another day. Now, the one thing you do have to remember is that it's not just company trading losses that can be carried forward against anything at all, subject to the 5 million and 50% of the excess above 5 million. There are other losses that you can get relief for, and they're incredibly generous. For example, if a company has got non-trading loan interest payable, if you look at page 16, this is an extra chapter at the end that I'm going to leave you to read, but I'll just highlight it. You know, I'm not too worried if HMRC ever say in the tax computation, this is non-trading interest. And we say, yeah, okay. Because with non-trading interest, if you can't relieve it, you can carry it forward subject to the 5 million and 50% in excess of 5 million legislation. You can do the same with rental losses as well. And my notes on page 16 and 17 set out the relief you can get if you've got a rental loss, which is fantastic. You can set it against anything in the same period or carry it forward subject to the 5 million computation, and likewise with non-trading loan interest payable. The only relief that is a bit restricted is capital losses, capital gains tax losses, if you like, if you can call them that for companies, because they can only be set against capital gains, nothing else. But my chapter there sets that all out. Right, now we're getting towards the end. So if I could ask you to move on to the appendix, page 19 of the notes. You go to the appendix, and I put a little appendix in there for you. Bonus or dividend. Now, quite often when you're doing the computation, when you're sorting the corporation tax out, the client might say, well, I've got some spare funds in the company this year. What's the best way of getting the money out of the company? Should we pay a bonus or should we pay a dividend? Well, the landscape's changed. Dividends now, the income tax on dividends is very, very expensive, really expensive. And dividends now, you know, you used to have an exemption of £5,000 per individual. So a husband and wife, if they got dividends, they used to have 10,000 tax-free on their dividends. Then it reduced to 2,000, then 1,000. It's currently 500. And the rumor is that it's going to be nothing next year. So the dividend allowance is peanuts now. It's £500 a person. Very, very disappointing. And also the income tax rates on dividends have shot up. And I think they're too expensive. For example, if you're a 45% taxpayer, you now pay 39.35% on dividends, income tax. And you ought to remember the dividends are paid out of company profits that have already been subjected to 25% corporation tax. So we use software, you know, and we put the figures in and we think, should we pay out a dividend, client pay out a dividend or a bonus? And in a lot of cases now, particularly for higher rate income taxpayers, it proves better to pay a bonus rather than dividend. But you'd have to look at the individual figures, individual facts. Have a look at that appendix. If you've got any queries on that, you could contact us subsequently. Right, now that's more or less it. I think my timing today has been pretty immaculate and I've covered everything I wanted to. Can I just say, as I said at the start, if you've got any tax consultancy needs, you're doing the computations and you think I need some help in this area, reach out to us. You can contact Tom, your focal point, reach out to us and we'd be delighted to help you in any area affecting corporation tax or in any tax area full stop really. But reach out to us. If I've said a few things today and you think, yeah, I've got somebody who's in this area, I need a bit of help, we'd be delighted to help you. And finally, can I just remind you of the future events that Gravita is putting on? And you want to note these events for your diary. If you go to our website, they're all there and you can sign up as well. But these are the events that we're putting on next week, for example. Next Wednesday, the 3rd of July. Is it July already? Isn't there a big day the following day? Wednesday, the 3rd of July, Tom is going to be talking, and also Richard from the accounts team. They're going to be talking about succession. And, you know, my area that I've used a lot on succession is employee ownership trusts. And I know it's a big area that Tom's very keen on. I would recommend that you strongly have a look at that. If you haven't booked on, I think you should, because it would be very useful for you. If you've got clients who are trying to sell their business, pass it on to the next generation, want to sell to the management team, that's next Wednesday, 3rd of July at 9 o'clock. And as I mentioned at the very start, we've got transfer pricing at the end of July. If you're on holiday, that's something that you should very much have a look out for on your phone. Tuesday, the 30th of July, transfer pricing. If you've got clients affected, you want to watch that webinar. A more general webinar is on Wednesday, the 21st of August. And I'll be presenting this from Jamaica, not quite. I'll be back by then. But business tax refresher, and seriously, I'm going to try and cover so many different things for sole traders, partnerships, and companies. And also that conference will be business, you could note, will be business tax refresher following the election. And then the final one in October, we've got an interesting webinar on landlords, because I do think landlords tax will be changed following the change of government as well. These are very, very interesting tax times. And we at Gravita try and help you. And if you have any tax consultancy requirements, reach out to us. We'd be delighted to assist you. Right, can I thank you for watching? I look forward to seeing you again very soon. Thank you very much. Enjoy the rest of your day.